86.29 USD. That is the number staring back at us from the monitors right now. Target Corporation, ticker symbol TGT, is trading at $86.29, currently down 2.56% on the session. The intraday chart is painting a picture of exhaustion, a jagged red line that opened with a gap lower and has been struggling to find a foothold throughout the morning session. While the broader market might be looking for direction, target investors are currently absorbing a very specific, very tangible shock. We are seeing volume spikes on the sell side every time the stock attempts to reclaim the $87 level, indicating that institutional liquidity is providing resistance rather than support at these levels. If you are watching the order book, you can see the pressure building. This isn't just a quiet drift lower, this is an active repricing of the retailer's future value. Expectations for Target have long been anchored in a specific narrative that it is the safe retailer, the slightly upscale alternative to Walmart, where the dividends are secure and the aisles are clean. The expectation was that as inflation cooled, the Target shopper would return in force to fill their red carts with home decor, apparel, and high-margin discretionary items. The reality, as exposed by today's price action and the breaking news, is starkly different. The reality is that the American consumer is not just being selective, they are undergoing a fundamental behavioral shift that leaves Target's specific business model vulnerable in ways that algorithms and casual observers missed. While you might be distracted by the high beta volatility of Tesla stock or the relentless upward march of Nvidia stock, the real economic barometer is flashing red right here in the retail sector. The disconnect between what Wall Street wanted to see, a resurgence of discretionary spending, and what Target just delivered, is the source of today's pain. Investors expected a recovery story. They got a survival story. Let's look at the catalyst driving this movement. Target released its third quarter fiscal 2025 earnings report this morning, and the details are what we call a noisy beat that masks a deeper structural issue. On the surface, the headline number doesn't look catastrophic to the untrained eye. Adjusted earnings per share came in at $1.78, which actually beat the consensus estimates of roughly $1.76. In a normal market environment, an earnings beat often triggers a relief rally. So why is the stock down nearly 3%? It is because the revenue side of the equation failed to show up. Revenue came in at $25.27 billion, missing the mark. More alarmingly, comparable sales, the holy grail of retail metrics, declined by 2.7%. When you compare this to the performance of competitors who are seeing growth, it suggests that Target is not just losing to the economy, it is losing market share. The company also slashed its full-year guidance, lowering the expected earnings per share range to between $7 and $8, a significant drop from the previous outlook. This guidance cut is the equivalent of a CEO waving a yellow flag on the field, signaling that the fourth quarter, the critical holiday season, is not going to be the savior everyone hoped for. This price action we are seeing today is a classic case of guidance capitulation. When a company beats on the bottom line but misses on the top line and then cuts the future outlook, it tells smart money that the current profitability is being manufactured through cost cuts, not driven by organic demand. It is the financial equivalent of holding your breath to look thinner. You can only do it for so long. We are seeing heavy selling pressure from funds that likely held Fidelity mutual funds or similar institutional baskets as they rebalance away from discretionary exposure. If you manage your own Schwab Intelligent portfolios or use interactive brokers trading platforms, you might have seen the notifications flashing early this morning. The sentiment has shifted from buy the dip to sell the rallies. The intraday low of roughly $85.88 is a level that technical analysts are watching closely. If that floor breaks, we enter a price discovery mode that could revisit lows not seen in years. To understand why this is happening, we have to look at the specific mechanics of the retail environment in late 2025. Target sits in a precarious middle ground. It is not a pure grocery play like Kroger or a low-cost leader like Walmart. It relies heavily on you walking in for milk and walking out with a throw pillow, a new sweater, and a scented candle. That is the Target effect. But right now, consumers are walking in for the milk and walking right out. The discretionary categories, apparel, home goods, hardlines, are seeing continued softness. The company's report highlighted that while frequency categories like food and beverage are holding up, the high-margin stuff is sitting on the shelves. This mix shift is deadly for margins. Selling a gallon of milk yields pennies in profit. Selling a designer collaboration dress yields dollars. When the sales mix shifts towards essentials, the company has to work twice as hard to make the same profit. Furthermore, the comparison to Apple stock is interesting here, not in terms of product, but in terms of ecosystem. Apple keeps you in its ecosystem through software. Target keeps you through experience. But if the consumer's wallet is pinched, the experience of shopping becomes a luxury they cut. We are seeing a bifurcation in the retail sector. Walmart stock has been performing significantly better this year because their supply chain dominance and grocery focus make them the default utility for the American family. Target is viewed as a nice-to-have, and in this economy, nice-to-have gets cut from the budget. Whether you're using Robinhood stock trading apps to track these movements or a more complex Fidelity trading platform, the divergence between TGT and WMT is the most important chart you can look at today. It tells you that the market is rewarding efficiency and scale over style and curation. Let's step back and look at the company itself for those who might be new to the ticker. Target Corporation is a Minneapolis-based general merchandise retailer that has historically differentiated itself through cheap chic. They partner with designers, they maintain cleaner, brighter stores, and they position themselves as the upscale discount option. It's a brilliant business model when the consumer feels wealthy. When housing prices are up and credit flows freely, Target is the king of retail. However, the business model is capital-intensive. They have invested billions in their stores as hubs strategy, using their physical locations as fulfillment centers for online orders. While this was celebrated a few years ago as a way to compete with Amazon, it also brings high operational costs. If store traffic dips, as it did this quarter, down significantly, the fixed costs of running those bright, well-staffed stores start to eat into profitability very quickly. This brings us to the online component. Target reported that digital comparable sales grew 2.4%. That sounds good, right? But in the world of online investing in e-commerce, 2% growth is anemic. Amazon and Walmart are posting double-digit gains in their digital arms. Target's digital growth was led by same-day delivery services, which are expensive to operate. So they're getting a little more digital volume, but it's the kind of volume that comes with lower margins due to shipping and handling costs. Investors using investing sites and SoFi active investing tools to analyze the return on invested capital, or ROIC, will notice that Target's ROIC has compressed from 13.4% to nearly 16% a year ago. That is a metric that sophisticated capital watches like a hawk. It means the company is becoming less efficient at turning $1 of capital into $1 of profit. The technical setup on the chart is equally concerning. TGT has broken below its 50-day and 200-day moving averages, creating a death cross pattern that often signals further downside. The stock is now testing support levels that date back to the post-pandemic hangover. If you are engaged in self-investing or looking for investment help, a technician would tell you that catching a falling knife like this requires extreme patience. The Relative Strength Index, RSI, is diving into oversold territory, which usually suggests a bounce is due, but in a scenario where guidance is cut, oversold can stay oversold for a long time. The market is repricing the risk premium. Now, I want to pause for a second and ask you about your own experience. We talk about these numbers, but they represent real shopping habits. Comment below how many shares of Target you currently hold, or tell me, have you stopped buying fun items at Target recently? Are you sticking strictly to the grocery aisle? Your on-the-ground experience often predicts earnings better than the analysts do. Moving to the macro view, this Target report is a warning shot for the broader economy. If the middle-class consumer, Target's core demographic, is pulling back this hard on discretionary spending in November right before the holidays, what does that say about the health of the U.S. economy for 2026? It suggests that the soft landing narrative might have some holes in it. Inflation may be down, but price levels are still permanently higher and wages haven't kept up for everyone. People are making trade-offs. They're choosing between a new TV and groceries. Target sells the TV, Walmart sells the groceries. That is the simplification, but it holds truth. This is why we see funds rotating out of consumer discretionary stocks and into defensive sectors. However, we must